What is up, everybody? Today we're going to be talking about how to get started investing in real estate, or if you already own a home and you want to start getting some rental property and maybe just start learning about investing in general. This is going to be a really good video for you. I'm going to be sharing what I've learned throughout my time of real estate investing from different mentors, from experience, making a lot of mistakes, and hopefully, you can get something good from it. So, first things first, how do you go from just living in a home, your debt to income ratios is as high as it can go? Pretty much you can't qualify for another house because you already have one, right? So, one thing you can do if you have a spouse, you have your spouse do the first home, they qualify for the first home, and then you can do the second. That's what we did. Or you can go the non-traditional route, the non-bank route. So there is a loan program out there called the DSCR loan, Debt Service Coverage Ratio loan. They don't go off of your personal DTI. They just want to make sure that the property will cash flow. And by cash flow, I just mean making sure that the income generated is more than your expenses. One route that's very popular since the DSCR loan is a 20% down payment. A very popular route is doing hard money. So, a hard money loan, the down payment is generally a lot lower. On a $90,000 property with a $30,000 rehab, you might be looking at a $5,000 to $7,000 down payment, right? But then what you do is now that you've made the property very valuable, you do a cash out refinance with a DSCR company, and you can do up to 80% for some of these companies. A lot of them will do 75%. You get a new loan at 75% of the value, and then you take that and you pay off your hard money loan that was high interest. Now you have a new long-term fixed rate, and you just hold on to that, and then you just refinance later down the road when rates go down and pull out your equity. So there's a lot of different ways. I was stuck on this. Okay, how now that our DTI is maxed out, where do I go? How do I do it? Another way is by raising capital. So if you know somebody that has some money that's just chilling in the bank, and you'd be surprised how many people have money that's not active, it's not working for them, it's in their 401k, it's not making them much money, and you show them, hey, I can make you 15 or 20%, right? Okay, cool. So you borrow their money at 15%. You want to start off a lot lower than that. Say 12%. We actually have private lenders now down to about 7%. But if you're just starting off, say around 15%, build your credibility. Take lots of photos and make Google Drives so that you can show potential investors what you've done. Bigger Pockets has a really good platform, and it has a really good PDF and presentation model that you can do on Bigger Pockets. Once you start building your portfolio, yeah, you can start bringing in private money. And another thing that I think that you can do to accelerate your real estate portfolio is flipping houses on the side. So if you flip some houses and then you use that capital to buy more property, and there is a concept I actually learned the other day. So there's something called the bell curve. I knew about the book on the intelligence side of things, but the investor bell curve is like this. And at the beginning of the bell curve, you have you're just starting out and you're investing into C class properties. So C class is like your lower income working class properties. That's exactly where we started out. And then as you go up, 2 to 5 years, and then you get in the B class. That is your more middle class, upper middle class areas. And then once you get up here, you're at your peak portfolio. Then after your peak portfolio, you start paying off your debt. So right now we're trying to get some apartments. So we got that going in the works right now, getting some apartments. They are C class, but then as you go from C class to B class, the properties are generally newer. Generally, they are in a lot better condition, a lot better neighborhood. They're in an area that's growing a lot more, less crime. Crime's a big factor on that. So really, just depending on where you're at on the investor bell curve. I know some people that are up here just from saving. Like they just have a lot of money, and they just did a couple deals, and now they're ready to continue to scale. But generally, when you're starting out, you're generally going to start out at the bottom left side of the bell curve, and you're going to be getting your C classes. You're going to be doing flips, some wholesales if that's for you. You're going to be buying C class properties. You do BRRRR. If you don't know, BRRRR, buy, renovate, rent, refinance, repeat. So you're going to buy the property, make sure that it's a good deal. You're going to renovate it. You're going to rent it out. You're going to get a tenant in there. Then you're going to take your cash out. And then you take that money, you roll it into another property. So the BRRRR is really good for the left side of the investor bell curve. As you're building up your capital, when you're at your peak portfolio, that can really be anyone, depending on your age and your goals. Your peak portfolio can could vary depending on who you are. So for me, my goal is to have my peak portfolio be at about 7 years, give or take, and then at that point, I want to start paying everything off. I want to have my personal residence paid off in about 3 years. But in terms of my entire portfolio, I would like to have most of it paid off in about 15 years, give or take. Because I really believe that real estate is an excellent retirement plan because the tax benefits and your net return is a lot higher than most dividend stocks. It is good to, of course, diversify with dividend stocks and things like that, but real estate is for people that have a little bit higher risk tolerance. And if you want a lot higher, a lot more tax benefits, real estate's really good for you. But yeah, if you're just getting started in real estate, I want to make sure that I try to keep this really simple. So, in case I lost you, let me bring it back down to earth for the new people out there. Um, Whenever you're just getting started, tips and tricks, you want to make sure that you have lines of credit because when stuff hits the fan, and it will, you want to make sure that you're not having to dip into your savings or your retirement or anything like that. So open an LLC, get a business credit card, and if you gotta buy, a couple $1,000s worth of lumber or a couple $1,000s worth of appliances for your flip or something like that, then put it on your business credit card, get the points, and then pay that off. That way you're not accruing interest. A lot of these business credit cards have 0% APR, so that way you don't have to incur interest. But you don't want to be coming out of your own pocket. That's something I just recently learned this year was like use other people's money as much as you can. I always believed in the concept, but now I'm starting to really, really implement it. I don't feel like touching my money and interrupting my compounding because my money needs to be working for me and growing. If I'm constantly pulling away from it to fix stupid stuff like plumbing and things like that, then that's really going to mess me up in the long run. So have lines of credit, know people that have money. Don't be afraid to borrow money from them because you're helping them. It's a win-win. If you give them 12%, that's much higher than they're probably getting most years on their portfolio. The S&P averages 7 to 9%. So that's a good return. Don't be only flipping houses. Make sure that you're buying some and holding some. This is a long-term game. If you're just flipping houses all the time, then you just have a normal job essentially. You're going to be taxed at short-term capital gains tax 37%. You're going to be busy. You're not really tax advantaged at all. So make sure that you're putting some of your flip income into long-term buy and holds. And if you're still listening at this point, then you probably might want to know what a BRRRR looks like. This is just really just me just throwing out the little bit of knowledge I know. Of course, I can go into a little bit more depth, but let me just try to keep the BRRRR kind of simple. So BRRRR, you want to buy a property that is a fixer-upper, preferably, and you want to make sure that after all the fees, after all the renovation, everything, the total amount that you are into the property is no more than 75% of the value of the property after you repair it. For example, I buy a house at $80,000, right? I know that after I repair it, it will be worth $200,000 because the other houses in the area, once they're repaired, are worth $200,000. So what I do is I buy that one for 80, probably using hard money and private money in this scenario. But what I mean by that is using an asset-based lender and also a investor using their money. I'll buy that, and then they'll also fund the renovation. A lot of the times, the hard money company will fund the renovation. Let's say it needs $40,000 of work. Cool. After all the fees and everything like that with working with the lender, let's say I'm all in at 130. Okay, cool. So I know that once it appraises, it'll appraise for $200,000. So to figure out what your new loan will be once you do a cash out refinance, what you do is 75% of $200,000. That gives you 150. So if you were all in at 130 for your original loan and all your fees, and your new loan is 150, you pay off your old loan of 130. You keep the difference between your old loan and your new loan, which in this case is $20,000. Now you have $20,000 in an asset that is hopefully cash flowing you a couple $100 or more a month, and you've got all your money back and then some. You've got that asset. It's not on your DTI because with hard money and using private investor capital, you can actually buy in an LLC and close in an LLC. You don't have to do it in your name, so it doesn't touch your DTI. Don't let a lender try to push you on that. It's just not the case. If it's in the LLC, it's not on your personal DTI. That's the whole point of that. So yeah, you would get that money back in that case. You want to make sure that you actually run your comps properly. So we've been burned on this a couple times. So your comps, this can make or break your BRRRR. So a comp is a property that is comparable within a mile, but really you want to look like a quarter mile if you can. Some banks like will really only look within a quarter mile, unfortunately. So I've heard stories of a bank having a good comp about a little under a mile away that closed 3 months ago, but they're like, okay, cool. Let's only look a quarter mile in. Go back even further than a year if you have to, which is crazy. The proximity is key. Like the closer, the better. And you have to push back on these appraisers sometimes. Sometimes they'll try to screw you because they don't care. They're just going through the motions. We had an appraiser try to say that our bedroom that we added a closet, it had a window, it had an exit door and an entry door. Tried to say that it was a living room. Tried listing the house as a 3-2 instead of a 4-2, and it hurt our valuation. They tried saying it wouldn't affect our valuation. We pressed back on it hard. We were going to report them to the appraisal board, and they actually reevaluated the house and gave us a higher evaluation. So don't be afraid to push back on these guys. They're not used to it, so they're going to make you feel like the bad guy, but sometimes in business you have to be the bad guy. It is what it is. Always be respectful, kind, and trustworthy, of course, but if you wanting them to be accountable for doing their jobs properly makes you the bad guy, then so be it. That's just their fault for having a faulty definition of what a bad guy is. Anyways, I digress. You want to make sure that your comps line up. So with your comps, make sure that the comps in the area have the ARV that you're going for, the after repair value, and it really is based off price per square foot. So, for example, let's say you have 5 houses in the area that once they're renovated, they appraise or sell for $150 a square foot. Well, that's what you want to go off of. If the comps, they're all 4.2s or whatever, you're going to average that out. If some are 125 and one are 175, if it averages out to 150, you go with that 150, and then you multiply the price per square foot from all the comps averaged by your square footage of your house. You can actually just go and you can look at a fixer upper that's for sale, or if you know somebody, you're usually going to get a better deal off market. If you know somebody that has it, or you've dug and you've made some phone calls and you found one, and you see that homes in that area are selling for double what you can get for this, or even triple sometimes, then what you could do is you can look at the price per square footage of these homes, and then you average them all out once, make sure they're renovated. And then you take that average and then you multiply it by the subject property that you're interested in, that price per square foot, and that'll give you the after repair value of that house. If after all renovation fees and everything, you're all in at no more than 75%, it's a good deal. You can buy it, you can renovate it, you can rent it out, you can refinance it, you get all your cash out, and then some if you're lucky. And you have a renter, and now you have all of your money back out. So it's almost like this. Imagine you buy a stock like Coca-Cola that gives you, let's say, a 4% dividend. Let's say you buy $10,000 worth of Coke stock and they give you 4%, right? So you get $400 a year, give or take. So yeah, $400. So then you can take that $10,000, put it back in your bank account, and go buy another stock, but you're still getting $400 in dividends. Would you do that? Yeah, I would do that every day. It's kind of a no-brainer once you think about it like that. Cool. Well, yeah, really long video. I hope that y'all learned something. Comment below or share if you think that somebody might find this valuable, and I hope y'all have a good one.